when everything gets more expensive, it's easy to blame everything getting more expensive for overspending, when oftentimes that's not the only reason. And for a lot of people, the overspending is just simply because they have gotten used to spending more money on more things, but ultimately want to blame inflation instead of evaluating their behavior and their spending habits.
Welcome to Upticks with Jake Falcon, founder and CEO of Falcon Wealth Advisors. In this podcast, we help high net worth individuals overcome financial complexities. We do this by enhancing financial literacy and discussing topics in a language free from industry jargon. Join us as we help explain exactly what having a solid financial plan means, as Jake draws from years of experience in helping hundreds of individuals get financially organized and focused on their goals. We hope you find Upticks educational, entertaining, and shareable. Now, on to the show.
Welcome back to Upticks with Jake and Cory. Cory, welcome back to the show.
Jake, thank you for having me back.
Yeah, and we're into 2024, and the days just keep rolling along here. I am excited to announce that Rachel and I are going to be moving here very soon. And so that's going to be a mess and a lot of fun. But, it's all self-induced. So there's no complaining. No complaining, Cory.
You heard it here first, folks.
But we're real excited to be back on the Kansas City, Missouri side. And we're looking forward to our new house. It's, Cory, it's getting painted on the inside right now. And we were over there the other day. And it's just a really cool house. So we're really excited.
I'm excited to see it. And we're going to be neighbors.
That's right. We are going to be neighbors. Not that we don't work close enough together already. We're going to live close to each other. It'll be fun. It'll be a lot of fun. And anything new in your life?
Not too much. We're geared up for the new year. That's really it. Staying focused and getting started strong.
All right. Well, speaking of getting started strong, let's dive right into our headlines, Cory. And I've got some fun sound effects today. So let's let you kick us off.
Charge. All right, Jake. The ultimate personal financial checklist to get ready for 2024. What is on that checklist?
Yeah, I read this article in Bloomberg, Cory. I thought it was a really good one, obviously, or wouldn't have made it to Upticks. We don't put any bad articles in the show. Right. And before I go into the checklist, first, I want to thank all of our listeners and our subscribers, Cory. Our subscriber count continues to grow, and our downloads and all of that is increasing. Again, the whole point of Upticks is to enhance financial literacy. So the best way that you don't miss an episode of Upticks is to be sure to subscribe. Also, if you want to share, give a thumbs up, 5-star review. We really appreciate it. We're doing this to help people, right, Cory? That's why we're doing this.
That's right.
All right. So speaking of helping people, let's talk about the ultimate 2024 personal financial checklist. Number one, Cory, is get your passwords in order. We all have them, right? If you have a computer or a phone, more than likely, you've got several passwords out there floating around. This checklist recommends writing them down, which I think is a little dangerous, because maybe you got to put them somewhere, right? So writing them down in a secure, safe place, or there are password managers such as LastPass or 1Password. I don't use an app to track my passwords, Cory, but I am considering it. Before I go into the second item on the checklist, do you do something to manage your passwords?
No, I don't. It's funny you said that because I'm the exact same way. I know I need to get an app. I know I need to do it, but I haven't.
I'm scared to get an app because then there's another thing that can be hacked. I don't know.
That's my thinking too.
So anyways, but I like it though, because I do feel like my passwords are all over the place and it's frustrating. So that's number one. Number two is take stock of your subscriptions. We all have them, right? Whether it's Netflix or Spotify or whatever, right? We're paying these monthly small bills to things. And the best way to go about doing this is just to go look at your credit card statement and see what reoccurring charges you have. And if you're not watching Hulu, Cory, cut it, right? So I thought that was a good one. Take stock of your subscriptions, organize your tax documents. Not a fun activity at all. I do recommend getting a folder, either whether that's on your email platform, if all of your documents come electronically, or literally a physical folder. My accountant does a pretty cool thing. I don't like it, but he does it. He sends this long, ridiculous checklist at the beginning of every year, asking for all of these documents and all these changes. I do fill it out loosely for him. It does help me get a little bit organized. So again, just making sure that you're ready to have all of your tax documents. I like this one, Cory. Set up auto deposit, not necessarily auto pay. And we've talked about this on previous shows of Upticks, but auto deposit. So let's make sure that your savings, checking, if you're still working, your 401k, all of that stuff is lined up. Check your investment portfolio, right? We had a really good 2023. Now may be the time to rebalance or double check the investments that you have. And then look at the calendar. If you're expecting any big expense in 2024, you can plan out, and budget for them accordingly. Weddings, vacations, family visits. Let's just make sure that you are set up for some of those big ticket items as they present themselves. Thought it was a good checklist. You have any thoughts on it before we go to the next one?
If someone went through that checklist step by step and addressed each of those, that would be rock solid.
That would be.
It is a good checklist. Going through that, Jake, there's a number of those items. I'm like, I need to do it. I need to do it. I need to get those passwords figured out.
Good. And again, don't feel overwhelmed. That's the other thing. Like, Cory, you and I have talked about this. We are not big New Year's resolutions guys. And again, I'm not suggesting that you use January to change your whole life, because what will happen? You won't do anything. So again, if from this checklist, you can pick one or two things and implement it, great. Let's start with your passwords. Let's get those in order, feel a little bit more organized about things, and let's move on. All right. I like it. That's good. All right, Cory, for your next headline, you've got rotation more than just a calendar change. What are we talking about here?
We're shifting more market specific here for a moment, Jake, and I have a couple of charts for you bright and early here in the show. So first off, the chart that's highlighted here, so this is from Strategic Research Partners, and this is actually a report that was just published that's really highlighting what performance in the market has looked like over the last several months and the last several quarters. What I found really fascinating about this is we've talked on the show, Jake, about the equal weight S&P 500, about the cap weighted S&P 500, the difference between the two. Equal weight is really what we use for our core portfolio. What they highlighted here, some notable takeaways, is that since October 23rd, when the interest rates peaked, October 23rd of last year, 2023, the equal weight S&P 500 has outperformed the Magnificent Seven, which got plenty of airtime in 2023, by almost 5%. And since the short-term low in yields, so as they've bottomed and moved a little bit higher on December 27th, we're talking real short time frame here, though, the equal weight S&P 500 performance has continued to outperform the top of the market by 2.5%. And that's really what's highlighted on this table. And below that, Jake, is a great chart that's looking at small caps and large caps, value stocks versus growth stocks. And the main takeaways from this is that large cap growth, which has dominated the market, has really broken its trend line relative to value, and small cap growth and small cap value peaked back in June. So the point here is a rotation change that I'm talking about and that they're highlighting here is talking about within the different sectors and styles of the market. And while the Magnificent Seven received a ton of airtime and discussion in 2023, the point here is that there could be some shifts underway. And I, just like they've highlighted in the checklist you went through, Jake, think all of this is a great reason to reevaluate your investment portfolio at the beginning of a year.
All right. I want to be clear here, Cory, that we're not going to use these charts, though, to predict the future. I think what they're just saying is that there are some divergence, and people that have chased the Magnificent Seven, which are companies like Microsoft, Google, Amazon, again, quick disclaimer, none of this is investment advice. We're not telling you to go do one thing versus the other. All you're making is a simple observation. But I think a good note of this chart, and again, it's so short term though, Cory, that's why I don't like it, but you don't want to go chase fads as they present themselves, because basically what this is saying is that now those Magnificent Seven are underperforming some of the smaller companies. And if you went and backed up the truck and said, I'm just going to buy these 7 stocks, Cory, because they've done so well, now you're probably underperforming over the last few months. So I get it. But again, don't take this as an investment advice. You should sit down with your wealth advisor, develop your investments according to your financial plan. And Cory, these charts are fine, but I'm not going to predict the future from them because they could be wrong.
The first one isn't even looking into the future. It's just looking at the past.
Yeah, whatever. They are. But anyways, that's another topic for another show.
Okay.
What's next,
Jake? So more Americans than ever own stocks.
Yeah, this was an interesting point that today, and I don't know if you read my notes, Cory, but do you know how many of U.S. households, what the percentage is, own stocks today? Did you look at it? And if you looked at it, that's fine.
Right around 50%. I did not look at it. I'm
That's your
guessing
guess?
around 50%.
50?
Yes.
Your guess is 50. Okay, pretty close. It's 58%.
Okay.
And this is back in 2022. That's
Mm,
up from 53% in 2019.
mm.
Now, most times it's through their 401ks, which makes sense. However, the pandemic and Robinhood caused many people to jump into the market. And so my question to you, Cory, is how can this be bad? Is this a bad thing that more and more people are investing in the stock market? I'm trying to understand, wrap my head around, like, what could be bad about that?
One thing that could be bad about that is if there's more people, Jake, I suppose, that have more of their wealth concentrated in one type of asset, whether that's public equities or real estate or whatever it might be, that could pose an issue.
Yeah,
I
but
do think,
I would argue that these people probably weren't investing at all before. So they're
right,
taking cash from their piggy bank and putting it in the market. Now, if you go back 100 years, the stock market was for rich people, right? But
correct.
I love what's it called, the democratization
Yep.
of what Robinhood has done, because Robinhood came out, Cory, and made it free to trade. Whereas before, we're talking in the 80s and 90s, more than likely you had to have a broker. They were going to charge you big commissions. So it didn't even make sense if you didn't have big money. But now, I don't know I don't use Robinhood, obviously, but now you could have, I don't know, maybe $100, $50 and probably open an account and go start buying some stock. So I think it's good from an investing perspective. I think it's dangerous from an investment perspective, because I think a lot of
Mm,
people during the pandemic are treating stocks as gambling now. Like, literally, they're using it for entertainment, not what it was really designed. And then that's not what it was designed to do. It was designed to help support companies as they grow, and then you get rewarded because you're helping a business become bigger and better. So I think the danger, Cory, is more in the consumer, and they're
mm.
not understanding the risk that they're running by gambling, right? So if they're doing it to purely invest, that's awesome, but I don't think a lot of them people are. So it'll be interesting to see how that plays out.
I think so too. It is, yeah, almost 60% is still low. That is higher than I would have thought. When I
It is a
look at those
lot.
numbers, actually, that is higher than I would have thought.
It's a lot, yeah. All right, good. Let's go to the next one. Where did all the money go? The villain in your transaction history.
All right. I think you're going to like this one, Jake. The argument, I don't even know if I should say argument. The point, the takeaway from this article was that higher prices have made it easier than ever to miss the other sneaky cause of overspending, which is lifestyle creep. And lifestyle creep is gradually accumulating more expenses as your income grows, because we frankly think we can afford to treat ourselves. And the argument they make in this article is that differentiating your cost of living increases from your discretionary spending requires a long, hard look in the mirror, an evaluation of how you've spent money. Perhaps you could look at 2023 over the course of the calendar year. And they argued that you should make a backward budget, which is basically looking at how you spent money in 2023, strip out the non-essential expenses, and that will actually give you an idea of what your essential expenses are, and you can compare that to what it's looked like previously. The main point that they were pointing out here was that when everything gets more expensive, it's easy to blame everything getting more expensive for overspending, when oftentimes that's not the only reason. And for a lot of people, the overspending is just simply because they have gotten used to spending more money on more things, but ultimately want to blame inflation instead of evaluating their behavior and their spending habits.
Wow, that is a good article. Yeah, that's a really good one, Cory. And I think, this is maybe for younger or older people, but as our incomes grow over time, a big lesson in personal finance is to not necessarily adjust your lifestyle with your income. That's hard, very difficult to do, though, because you see more zeros in your checking account and the money's just sitting there and all of your necessities are taken care of. So now you want to go start layering on other things, a new car payment, a second home, subscriptions, whatever. You start adding these things up. And you're right, Cory. People always want to point the finger and blame inflation, blame the government, blame their neighbor, blame their boss, whatever. I really love that idea of going backwards. I've never heard of that, I don't think. Have you? Going
No, not called a
backwards.
backwards budget like that.
And I did this actually on accident, not from this article because I didn't read it, but I think it was yesterday, I went back through my food budget that I spent in 2023. Then I went and looked at 2022
Mm.
because Rachel and I we've changed up a lot on trying to eat healthier, and we've seen that as an investment. So I know we're spending more, but I wanted to see what that difference was so that I kind of had an idea, right, of how much more we were spending. So I kind of did a mini exercise of this, but I love it. I think it's a good idea. And again, I'm not discouraging people for upgrading their lifestyles. I think the point of the article is, though, saying you can't blame inflation alone for you spending more.
Yes. And yeah, exactly. And my takeaway from this too, Jake, is that if you approach your budget or you approach your cash flow from the perspective of saving and paying yourself first, the whole point in doing that is so you can spend money more guilt-free because you're prioritizing that savings first. And you can do that as your income grows or shrinks, but prioritizing that first is really what helps to keep this at bay, in my opinion.
Yeah, that's good. That's good. Very good. Take us to the next one, Cory.
Your 401k is up. Don't let it go to your head.
Right. This is a good one, Cory. So again, let's flash backwards.
Yep.
2022, more than likely, your 401k was down in value, or your IRA, your investments. 2023, hopefully, your account is up in value. And the takeaway from this article, Cory, is that now, because your account hopefully is up, is a very popular time for people to look at not only their 401ks, but their accounts in general, since, like I said, they're more than likely to be higher than they were when they started the year. But this is the key piece of caution, is that don't get overconfident and adjust your risk profile because of this. So my point is, if you are looking at it now, it may be a good time to actually rebalance or to speak with your wealth advisor at Falcon Wealth Advisors to talk about your investments or your 401k. The article claims that the more people look at their accounts, the worse their performance is, since they get scared of buying stocks and they end up being too conservative, actually, Cory, because they can't handle the up and down. So there's two things going on here. Is one, I don't want people to get overconfident and think, oh, I made whatever, 10%, whatever it was last year. I should be putting more money in stocks now because I could have made even more money, right? I don't want you to get overconfident and start blowing out a well thought out asset allocation or financial plan. But I wanted to hear your thoughts, Cory. Do you agree that people that look at their accounts frequently probably underperform or perform worse than people that don't? Probably, right?
Yes, because they're more inclined to make changes if they're going in there and looking at it. And our gut reactions typically is to our emotions tell us to do the opposite of what's logical. And the more frequently you're looking at it, the more likely it is that that's going to happen, in my opinion.
Yes, you're right. They turn into day traders. And this is known that sadly, the retail investor is historically late to the party. So when the market goes up, they want to buy. And then when the market goes down, they want to sell. And that's the exact opposite of what you should do. And actually, we subscribe to a contrarian philosophy where when most investors are scared, that's when we want to buy. And when most investors are greedy, that's when we want to sell, right? So we aim to actually do the opposite with our investing. And historically, again, there's no guarantee of the future, but historically, that has proven a prudent way to manage your capital. So I think it's good. Again, the takeaway here is don't get cocky. It's great. Hopefully your 401k is way up, but now may be the time to actually rebalance that thing.
It reminds me of a quote, and I don't remember, Jake, who said this, but the specific quote was, people think that they are a genius in a bear market and an idiot in a bull market. And both of those are hyperextended. Like you're not a genius when everything does great. You're not an idiot when everything does poorly.
Right. All right, good. All right, Cory, we've got time here for a couple more. Okay. So the next one here is parents are risking their retirement to support adult children. Wow.
This was from Bloomberg, and they noted that with younger generations facing tough economic circumstances, many parents are supporting their children long past the college years, and nearly half of young adults in the United States live at home, and millions more are receiving help with rent, bills, and everyday costs. For parents, it's a major expense that requires greater debt loads, depleting savings, and delayed retirement plans. What really stood out to me from this was that US parents spend about $500 billion every year on their 18 to 34-year-old children, which is double what they put towards retirement, according to estimates from a Merrill Lynch and Age Wave study. So people spend, on 18 to 34-year-old children, people spend twice as much money as they put towards retirement.
Oh my gosh, that is super scary. There's several things going on here in this article.
There are.
So one, right, first, it's so weird to me to live at home in your 20s or 30s. I mean, that was a great time of my life, Cory. And so, and I love my parents. I'm not saying that, but I'm just saying, like, that's when you grow up and become an adult. And I know a lot of people do it, and that was kind of the thing. And to be fair, the pandemic and there's been some weird stuff happened here lately. So I'm not picking on anybody if your children still live with you. But I am concerned about two things, actually. Population growth, because you think about it, if they're living with their parents, they're probably not getting married and having children. So that could be a huge issue for America down the road. You know, I believe it's China, right? Is struggling. I just read an article about this, that China's struggling with that right now, because I think they shrunk it. They didn't want people having kids, and now people don't want to have kids, but they need people to have kids for their economy. And the other issue, the thing that scared me, Cory, is that people are spending twice as much on their kids than they are putting away for retirement. So it's going to go full circle, as my expectation is that these kids are going to have to take care of their parents when their parents are in their 70s, 80s, and 90s, because their parents didn't take care of themselves because they were taking care of their children into their 30s. So it's a kind of a vicious cycle that's creating, and wowza, that's a good one, Cory. That's interesting. So I guess the takeaway is, just you need to be mindful of what you're doing. Now, get it. If your kid needs support and needs help, by all means, I'm not telling you to kick him out on the street, but maybe there's some things that you can do to support them so they can buy a home or rent an apartment, so that you can put money in your 401k so that you can retire.
Exactly.
Good one, Cory. All right, what's next?
Trick your brain into being better with money.
Yeah, this takeaway here, Cory, is that don't be ashamed if you're bad with money. So that's the number one, is I don't want people to feel guilt or shame. Some of the quick tips from this article is to schedule all of your bills to come in around the same day so you can keep organized and know that they will get paid, right? Because you know how it is. Bills flow in all the time, and sometimes people get behind or they slip them. Ideally around a paycheck, right? So that you can make sure they're all covered. I thought that was really interesting to get, and you can actually call. I think they said that you could call credit card companies and change your billing day. So
sometimes you can do it online.
Oh, really? And just change it right there.
I've seen it.
Yeah.
Yep.
Good. Another one I thought was cool, Cory, is that schedule a financial health day, like a vacation day, and spend time getting your money ordered and make it fun, right? Maybe you're going to go to a coffee shop or somewhere fun, whatever that may be. Make spending hurt by not saving your credit card info, and instead type it in every time. So, a lot of people, you go online, you're shopping, it's got your credit card, boom, boom, click, you're checked out, you're done. But just imagine if you had to literally punch it in every day, that might be, or every time you bought something online. Thought that was a good one. And you brought this up earlier in the show, and I'm glad you did, but it says, once you have your money in order, you can spend your leftover cash guilt-free. And I do this personally, right? So I make sure that I've got all my bills covered, obviously, that I've got all of my savings set up, right? Retirement savings, brokerage savings, wherever I'm going to save. Then I know that Rachel and I have X amount of dollars left over, and we can spend that on whatever the heck we want because it's not earmarked and there's guilt-free. So if I want to buy a new suit, if I want to buy some golf clubs, whatever, I know that the money's there for that discretion. And then also, Cory, and then I'm going to get your thoughts on some of this. One more last quick tip from this article is that budgeting too far in advance is actually dangerous because you ultimately don't stick to it or it becomes overwhelming. So it's okay to break up your budgeting. And I do this personally. I budget kind of quarterly. And again, that's because of the way my cash flow works. But making my budget items quarterly allows me to not feel like, oh, I've got to really save for X amount in December or October when it's January. It's like, no, let's get through the first quarter. I know I'm going to get paid again in the second quarter. let's do all the things we want to do, save everything, do our budgeting for that. And then we'll move on to April. Then we'll move on to July and so forth. So breaking it down a little bit there.
I'm curious, when you do that, Jake, do you think about any of the one-off expenses that you may have over the course of the whole year, things that you ultimately want to do, and then you find a quarter that you want to try to ultimately do that, as opposed to trying to worry about budgeting everything? I'm just curious, or do you literally think about it on a 90-day basis?
Yeah. So again, with this new house, right, there's a lot going on. And
Perfect example.
I've got some amazing interior decorators, Cory, but that stuff's not cheap. And so
nope.
They want to buy new furniture and wallpaper and there's curtains. And, we've told them we're going to do this in phases, right? So Rachel and I, it's kind of fun, are deciding what do we want to do in phase one? What can we afford? And then we'll move on. So you're right. So we are deciding what we want to pull forward and do first, and then pushing everything else back because we know we can't afford to do it all at once. That would just be, and B, that'd be reckless to do it all that quickly. So in my opinion, you got to live in the house a little bit and decide what you want, what you don't do and don't like. So yes, we do pull things forward, absolutely. Do you?
Yes, I do. Cassie and I talk about this, and we really prioritize what, outside of our regular cash flow, what are expenses that we expect to have or want to have over the course of the year. And then we fit in where that belongs during the year. And then we take it in stride. So at least that way we have a high level overview of what the calendar year looks like. But I'm not trying to concern myself too much right now with Q4 of 2024. Take it in 90 days at a time, but we know where things ultimately fall. And I think that it is interesting what this article has outlined here. And it's really good because it's so easy for people to feel shame about money and for people to feel shame about the way that they handle it, or the fact that they just may not have their arms all the way around it because no one took the time to explain, or nobody could take the time to explain to them the concepts that we talk about on the show every week. But that's exactly why we do this.
Yes, good. And I think that's a good segue, Cory, into some calls to action for today's show. And my call to action for our listeners and viewers out there is to just take a baby step, right? So don't feel overwhelmed by all of this. If it's something as simple as getting your passwords in order, great. You took a move in the right direction. If it's looking backwards on your budget, awesome. You took a glance back and saw where you spent money on food and other items. So let's just take a baby step. Let's just get out of our comfort zone just a little bit, just so that we can grow and become better with our money management. Cory, do you have a call to action?
Yes, take stock of your streaming services. You mentioned this on that checklist, Jake. That's one of my favorite ones on that. I already do this because I'm not kidding. I think that I enjoy canceling them just as much as I do signing up for them. But I like to do this on a regular basis because it can get out of control. And the cost for all these services has continued to climb. Sometimes I feel like it should all just go into a cable that plugs into the back of the TV, and maybe that would make everything easier. Maybe we've come all the way full circle, but that's good advice. And it's a good way to get the year started. It's a baby step.
Right. You're right. I think it's funny how everything used to be bundled. It got unbundled, and now they're going to bundle it again. It's so weird.
It's all fractured. Yeah.
It's so weird that it's just the same thing at restaurants. Sometimes restaurants do a la carte, and some restaurants do family style serving, or whatever it's called. I don't know, like all on the plate, I guess. That's not family. But my point is, it's weird how things go full circle. And I think the a la carte model is here to stay. And I think bundling, though, has a place also. So it'll be interesting to see what that streaming service versus cable and all that.
Yeah, and we're talking on a different caliber here, but the same concept applies, Jake. The same way that you and Rachel are not trying to do everything to your new home all at once. Just because there are streaming services out there doesn't mean that you have to sign up for every single one of them, right? And if you're going to add new things, print some on the other end, or ultimately you might find that you're spending a whole lot more money on something that may not be that valuable to you.
Exactly. Right. That's good. That's a point for a whole nother show. So with that, Cory, we are running out of time. So thank you again for joining me. Thank you all for tuning in and listening. Please share our content with your family, your friends, your coworkers. Again, the best way to do that is subscribing to either our newsletter, Upticks, which is a weekly newsletter. You can email Luke at falconwealthadvisors.com to get subscribed to that, or you can simply go to www.falconwealthadvisors.com. That's also where we host all of our content. Thank you again, and we hope all of you have a great week.
Thank you for listening to Upticks. Click the subscribe button to be notified when new episodes become available. Also, be sure to visit our website, falconwealthadvisors.com, and click the Contact Us button if you'd like to meet with Jake and his team.